Assalamualaikum and hello everyone. My name is Nur Narina Nada binti Azman from class BA2423C. So my content for this video is about the differences of Islamic finance and also conventional finance in terms of the value proposition, structure, operational mechanism and also the instrument offered by both Islamic and conventional finance. I'll start with the introduction. For Islamic finance, can be defined as financial or banking activities that link to Sharia compliance, which is Islamic law. The main principles of Islamic finance are sharing of profits and losses and prohibiting the collection and payment of interest by lenders and investors. Conventional finance are known also as conventional banking that basically focus on relies on customers' deposit and loans approach. It is also known that the basic relationship of bank and customers is always a debtor and creditor. Conventional finance are different from Islamic finance since it's focused on interest and profit that are not acceptable in Islamic law. Firstly, I will share about the value of proposition. Value of proposition of Islamic finance. Firstly, social entrepreneurship. Islamic financial are not approved any financial exclusion because it is stated in the financial intermediation. This will greatly improve the quality of the lives of consumers and make them financially empowered to be independent. Secondly is global integration. Traditionally, Islamic law does not reject foreign values unless they contradict the fundamentals of Islam. For example, unregulated public interest is allowed since it can be included in part of maslahah mursalah, which is one of the Islamic financial contract. Hence, the Islamic finance industry cannot afford to remain in a comfort zone. It must come up with products that are readily acceptable and tradable even in Western countries. Thirdly is an all-embracing Sharia compliance. All of the product development in Islamic finance contract must be linked with the Sharia Supervisory Board of Islamic institution. Lastly is expert of law of Islamic finance to work with Sharia scholar. Formal specialization in the regulation of Islamic finance is needed. This group of experts should be in a position to complement the functions of Sharia boards and, if necessary, may be appointed as members of those boards to provide the board with much needed guidance on the specifics of the regulation of Islamic finance product. Next is value of proposition of conventional finance. Firstly, geared toward consumer-friendly services. This is intended to give more attraction in terms of increasing profit to all customers. Their main objective is on making profit, but still, their value proposition is to give beneficial to partnership and all customers. Secondly is socio-economic benefits for the consumers. Responsible in investment in terms of socially is not important when recent global financial downturn since value proposition already included the society economics advantages to all consumers. Thirdly is give loan with a predetermined rate of return. This value is important for conventional finance. It is because income and pricing are crucial to the introduction of problems by conventional finance. Okay, so next is Islamic financial structure. In terms of deposit and financing, in the funds of investment, it can be one funds flow only. Once the returns are determined, those returns are shared between the bank and the customer in terms of deposit or investment. Customer and bank will have same returns and it will be known by both customer and bank. Not all fees can be charged and cannot be used in Islamic banking. Linkage between sources and use of funds. It is normally suitable for application or contract in mudarabah. It is included operation, treasury, and also legal. Next is conventional financial structure. Set up to collect the deposit and give loans back, such as income and pricing becomes important when introducing their product. The arrangement is managed by Treasury function tries to balance the returns to shareholders' fund. Prohibiting activity depends on the framework of each bank. The bank modus operandi is, firstly, bank receive deposit from customers' interest interest received and also distributed. And thirdly, loans to the bank and the fund at a rate of interest. Okay, so we'll move to the operational mechanism. The operational mechanism can be defined as a means of controlling the pace and direction of the initiative, thus one of the simplest though still critical elements. Firstly, deposit. Deposits are collected from savers under both types of institution for reward, irrespective a bank is operating under conventional system or Islamic system. The first differences is in agreement of reward. Under Islamic finance, the deposits are accepted through musyarakah and mudarabah, where reward is variable, while under conventional finance, reward are fixed and predetermined. For the risk sharing, under Islamic finance, risks are shared with depositors, while under conventional finance, total risk is stated by the bank. Secondly is financing and investment. Both types of institution, which is Islamic and conventional system, are providing financing to productive channels for reward. The differences is in terms of financing agreement. For the Islamic finance, they offering loans without reward because cannot charge on the interest, while under conventional finance, they offering loans for a fixed reward. Thirdly is prohibited element. It is the differences are lies in terms of investment. For the Islamic finance, they are free from prohibited elements, while under conventional finance, the allowance for investment in prohibited industries. This is included. A bank industry is included in buying or selling of something that is not allowed in Sharia compliance, like pork, pornography, dance club, and others. Hence, earning through investment in any of these activities is still allowed under conventional finance and not allowed under the Islamic finance. Fourth is zakat. It is differences in terms of zakat payment. For the Islamic finance, they will pay zakat as it is obligation in Sharia law and also pay government tax. For the conventional finance, they do not pay zakat but pay tax that's stated by the government. Okay, so lastly, I will share about the instrument offered firstly by Islamic finance. The instrument offered by Islamic finance is firstly is Suku al-Salam, known as asset-based security, which is used for liquidity management in Islamic banking system. It is an Islamic investment certificate or rate which is parallel to yield bond of conventional banks. Secondly is Ijara, allow customers to use the asset against fixed changes which is paid by the customers to the bank. Ownership on an asset may remain with bank or transfer to customer gradually. Thirdly is Murabaha. It is known as cost plus profit financing for asset acquisition. The owner of the capital is the current account holders and the Islamic bank. Okay, so move to the instrument offered by the conventional finance. Firstly is bill of exchange. Become the marketable security and can be traded in market, and its market value depends on interest rate and maturity life. No interest exists in bill of exchange, but its value is depending on interest. Secondly is customer deposit. When central bank increases the interest rate to tie the monetary policy, customers deposit more their money in bank. Interest rate is used as tool of monetary policy. Bank use these funds for investment as well as for their liquidity management. Lastly is equity share. Every share shows the ownership of the shareholders in the firm asset